Dear students, welcome to Module 5, Revenue Recognition and Operating Income. As before, I will solve a couple of problems from this module. The first problem we want to look at is this: constructing and assessing income statements using cost-to-cost method. So we have 3 years of cash collections data and the total, and cost incurred data and the total. We have to calculate the amount of revenue, expense, and net income for each of the 3 years using the cost-to-cost method. So what is cost-to-cost method? So under cost-to-cost method, you have to recognize revenue based on the percentage of costs incurred in a particular year. So percentage of costs incurred. So in 2012, our cost incurred was $20, and that was in percentage 20 for 2012 divided by the total cost, which is 85 over 3-year period. So this will be 0.2353, so 23.53%, but it is telling us to round percentages to the nearest whole number. Percentages to the nearest whole number, so 23.5, so that will be 24%. I'll write down here 24%. Now to calculate revenue, what we have to do, we have to take this cost incurred percentage, so 24%, and then multiply by our total revenue, which is 120 million expected revenue. So that should be 28.8 million, but it says round revenue and income to the nearest whole number, so it should be 29 million. So 29 million, 29 million. Our income will be revenue minus our cost. So it will be 9 million. Following the same process for 2013, our cost for that year is 30 million divided by the same total cost over 3-year period, 85 million, which is so 35%. So our revenue will be 35% times total revenue, the same 120 million. We will get $42 million for 2013, our income will be revenue 42 minus our cost 30. So $12 million. Following the same process, you will get for 2014, the cost is 35, percentage 41, revenue will be 49, and your income will be 14. So if you add all them up, the total cost will be 85, percentage, of course, 100%, revenue recognized, you used the total 120 million. So the total revenue will be 120 million. Your income will be 9 plus 12 plus 14. So 9 plus 12 plus 14, which is 35 million. Okay. Now there is a theory question. Which of the following statement best summarizes our conclusion about the usefulness of the cost-to-cost method for this company? I will leave this question to you. I want you guys to go over the chapter, and after you understand the concept thoroughly, you should be able to answer this question. Next one I would like to solve. The next problem is this one, question 4. Okay. So we have, at the beginning of the year, Penman Company had the following account balances: accounts receivable, allowance for uncollectible accounts. So allowance for uncollectible accounts is the amount a company thinks it probably will not be able to collect from its customers. That is why it is called uncollectible accounts. And a company at the beginning can come up with an estimate based on the historical record. It can come up with an estimate for the allowance for uncollectible accounts. During the year, Penman's credit sales were 1,606,400, and collections on accounts receivable were 1,570,400. The following additional transactions occurred during the year: write-off Boba's account, this amount; Reed's account, this amount; Fisher's account, this amount. So write-off basically means, or it happens when the company is certain it will not be able to collect a particular sum of amount from a particular client. In this case, on February 17, the company became sure that it will not be able to collect this much, 6,560, from its customer Bava. So what will happen is, when a company sells to its clients, it records sales, of course. The amount that is sold on credit, it will be accounts receivable. Those that are sold on credit. And when a company, and then a company decides how much it thinks it will not be able to collect from its customers. So that is where your allowance for uncollectible accounts come. So amount potentially not collected in future. Now, write-off is when the company is certain that an amount will not be collected. So what we have to do in this problem, we have to compute the ending balances in accounts receivable and the allowance for uncollectible accounts and show how Penman's December 31 balance sheet reports the two accounts. We also have another transaction on December 13, recorded the bad debts expense. So what is bad debt expense? So bad debt expense is when if a company records or creates an allowance for uncollectible accounts, it also reduces the income statement by the same amount. In other words, it records the same amount as bad debt expense on the income statement. So it will be reflected on the income statement. Reduces income on the income statement. So recorded the bad debts expense, assuming Penman's policy is to record bad debt expense as 0.9% of credit sales. So bad debt expense is equal to 0.9%, which is 0.009 of sales. So that basically means 0.009 times credit sales. What that basically means, the allowance amount is increased by 0.9% of credit sales regardless of write-offs. Okay. So we have to find out ending balances in accounts receivable and the allowance for uncollectible accounts and show how December 31 balance sheet reports the two accounts. So we started with the beginning of the year, and these transactions happen during the year. We have to estimate accounts receivable. We have to calculate accounts receivable at the end of the year. So our accounts receivable, I'll say ending balances of accounts receivable. So first, we have to take the beginning accounts receivable, which is 284,800, it's 284,800. And then we also sold an additional 1,606,400. So we will have to add this amount here. And we also collected. So these are not accounts receivable anymore. These are collected. These were collected, so we have to subtract this amount. Now, this company also writes off this total amount. So we need to find out how much is written off in total. So written off is 6,560 plus 3,840 plus this amount. So let us add all these numbers. So this is the amount that was written up. So that will also reduce our accounts receivable. So our accounts receivable will be now 284,800 plus 1,606,400 minus our collection and minus the amount that was written off because the client became sure this much will not be collected. So 300,560. So that is our accounts receivable. Now, less allowance for uncollectible accounts. Allowance for uncollectible accounts. Now, note that it says the allowance account is increased by 0.9% of credit sales, regardless of write-offs. So we have, this is our beginning allowance for uncollectible accounts. We have to take that amount and then we have to add our additional credit sales, which were 1,606,400, and then multiply by our 9%. Now, so this is our bad debt expense, but at the same time, remember, whenever a company creates an allowance for uncollectible accounts, it also reduces the income by the same amount, which is called bad debt expense. So, so this is our bad debt expense, and this is also our additional uncollectible accounts. So we have to add this. And then when a company actually writes off, what it does, it reduces the balances of the uncollectible accounts and then also reduces the accounts receivable. So in case of accounts receivable, we already reduced by the amount written off. We need to reduce the allowance for uncollectible accounts by the amount written off, which is 12,240. So now let's see how much we get. I have to do this again. I need to do the multiplication first here. And then I will press equal and then add 17,120 equal, and then subtract 12,240. So 19,337.6. So round your answers to the nearest whole number. So it will be 19,338. Now, when we report accounts receivable, we report net of the allowance for uncollectible accounts. So our net balance of accounts receivable will be our accounts receivable minus the allowance for uncollectible accounts. So accounts receivable net of allowance for uncollectible accounts will be $289,222. So that is our account receivable net of allowance for uncollectible accounts. So just a quick recap. This company had some amounts of accounts receivable. It had additional credit sales, and then it also collected some amount. So in calculating accounts receivable, we added the beginning accounts receivable and the credit sales, and then subtracted the amount collected. And then, because the company was sure that it won't be able to collect 12,240, it wrote off that amount of the accounts receivable from the accounts receivable. So you subtracted the total amount written off. That gives us our accounts receivable. Now, then we calculated the allowance for uncollectible accounts, which is the amount that a company thinks potentially, that is, there is a possibility that it may not be able to collect that amount, which is equal to our previous balance and then certain amount of any additional credit sales. So in this case, it is 0.9% of credit sales. Now, this is the amount that a company includes as allowance for uncollectible accounts. But whenever the company is sure that it won't be able to collect a certain amount, that reduces that balance too, in addition to the balance of accounts receivable, because it is not a possibility anymore. It has already happened. And when we are talking about allowance for uncollectible accounts, it reflects the amount that will not be collected potentially. So we subtract the return of amount from the allowance for uncollectible accounts too. And finally, we take our gross accounts receivable, subtract our allowance for uncollectible accounts to find out our accounts receivable net of the allowance for uncollectible accounts. Let us move on to the next question. Question 5. So in question 5, what we have here, at December 31, Barber Company had a balance of $672,000 in its accounts receivable and an unused balance of $4,160 in its allowance for uncollectible accounts. So what that basically means, unused balance, is, remember when a company makes credit sales, it estimates how much of that amount of credit sales it will not be able to collect. That is reflected as allowance for uncollectible accounts. And at the same time, this company reduces the income by the same amount, the amount that is that the company is doubtful it won't be able to collect. But when a company has unused balance, what that basically means, the company has allowance higher than the actual written off amount during that period. So we have to keep that in mind, that we have an unused balance of 4,160. What that means, our expenses in the next period needs to go down by this amount, because our return of expenses were lower than the allowance we created for uncollectible accounts. So we have subtracted too much bad debt expense. So moving on, the company then aged its accounts as follows. So it has a current balance of $553,600. Balance that is due for past 1 through 60 days is $76,800, and so on and so forth. Total is $672,000. So that is called aging analysis. The total amount due for a certain range of days. The company has experienced losses as follows. What it is basically telling us, based on its historical record, it tends to lose 1% of current balances, 5% of balances that are past due for 1 to 60 days, 15% of balances 61 to 180 days past due, 40% balances over 180 days past due. The company continues to base its allowance for uncollectible accounts on this aging analysis and percentages. Okay. What amount of bad debt expense does Barber report on its income statement for the year? So bad debt expense. So remember, in case of bad debt expense, what happens is when a company makes credit sales, it records an allowance for uncollectible accounts. And the company also reduces income by the same amount. And this is called bad debt expense, the amount that comes from the allowance for uncollectible accounts and reflected as an expense on the income statement. So we need to first calculate the allowance for uncollectible accounts. In this question, it is telling us the company continues to base its allowance for uncollectible accounts based on this aging analysis. So we have to find out 1% of current balance, 5% of balances 1 to 60 days past due, and so on and so forth. So I'm going to copy this here, paste here. So this is 1%. This is 5%. This is 15%. This is 40%. So I'll multiply this to calculate the total to go towards the allowance for uncollectible accounts. Okay. $1,600 times 0.01. Then we will add all these numbers. So that is the amount that the company thinks it may not be able to collect. So that is the allowance for uncollectible accounts. At the same time, that is the amount for bad debt expense. However, remember it has an unused balance of 4,160. So that means our bad debt expense will actually decrease by this amount because in the previous period, we already subtracted too much. So our bad debt expense will be 19,216 minus 4,160, our unused balance. Okay. I will copy this amount here. So that is our A. Now for B, show how Barber's December 31 balance sheet will report the accounts receivable on the allowance for uncollectible accounts. So very similar to previous question. So our accounts receivable, we started with how much? We had a balance of 672,000. And we did not write off any amount. Remember, your accounts receivable will decrease the gross accounts receivable when you have written off. And the written off happens only when you are sure that you will not be able to collect some part of your accounts receivable. So I'll write down $672,000 here. Now, how much is our allowance for uncollectible accounts? So our allowance for uncollectible accounts is our previous balance was 4,160. So 4,160 add our new from the aging analysis, 15,056. So $19,216. Again, we started with 4,160 for the allowance for uncollectible accounts. And then based on our aging analysis, we have additional $15,056 of allowance for uncollectible accounts. The total is 19,216. And to find out the net accounts receivable net of the allowance for uncollectible accounts, we need to subtract this amount from the accounts receivable. There should be one more zero here. $652,784. Save this. So that is our question 5. Question 6. So question 6 is telling us this company offers an unconditional return policy. It normally expects 2% of sales at retail selling price to be returned before the return period expires. Assuming it records total sales of $14 million of the current period, what amount of net sales should it record for this period? So net sales will be your total sales, which is 14 million, and you have to subtract 2% of that amount. So $13.72 million. Let us move on. Let us work on this question, question 8. Analyzing the allowance for uncollectible accounts. Following is the current asset section for the Mondelez balance sheet. December 31st, 2018, December 31st, 2017. So trade receivables, but we have a star mark here, which basically means it is net of allowances of $32 at 2018 and $40 at 2017. A similar thing for other receivables, we have net of allowances for these 2 years. First question, what is the common size trade receivables? Net. Trade receivables net. So we are talking about this amount at year end. Common size. So common size means we have to divide this trade receivables net by respective number. In this case, it is total assets because it is a balance sheet item, and total assets is the total total number for all assets, and trade receivables is one example of assets. So we have to divide trade receivables net by total assets. So it will be our 1810 divided by, it is talking about 2018. So 1810 is our trade receivables net for 2018 divided by total assets 50,183. So 3.61. So that is the correct answer. Others are incorrect. What do Mondelez's customers owe the company at December 31st, 2018? Customers owe. Okay. So for 2018. So when we are talking about customers, it is the trade receivables. And remember, this is the amount that is net of allowance. And what is an allowance? The company thinks it may not be able to collect, not sure. So if we are talking about the total amount the customers owe, we have to add back the net, we have to add back the allowances. So for 2018, it is $32. So it will be 1,810 plus 32, 1,842. So this is the correct response. What does Mondelez expect to collect from its customers at December 31st, 2017? Expect to collect in 2017. So that is the net of allowance and customers. It is talking about the customers. So we are talking about trade receivables, not the other receivables. So in 2017, 2,153. So that is the correct answer. What is the gross receivables at year-end 2018? So gross receivables. So what we have to do, we have to add the receivables. So 1810 plus 595. So 2405. It is talking about gross receivables. So we have to add these allowances too. So plus 32 plus 38. So 2475. So that is the correct. So it is talking about gross receivables, not net. Okay. What percentage of trade receivables does the company deem uncollectible? Year-end 2018 uncollectible is, and it is talking about only trade receivables. So this is the amount that is uncollectible, 32. So we have to take 32 divided by trade receivables, 1810. But remember, this amount, 1810, we got this after we have subtracted 32. So we have to add this back for the denominator. So 1810 plus 32. So our 32 divided by 1810 plus 32, which is 1842. So 1.74%. So 1.74%. Now F. Based on the analysis above, in which year does the company have higher quality trade receivables? Now, what is higher quality trade receivables? If a company thinks it will collect higher percentage, or it has a lower percentage of trade receivables, then it has a higher quality. So we already calculated for 2018, it is 1.74. So for 2017, it will be so for 2017, it will be our 40 divided by this 40 allowance, 2,153 plus 40. So which is basically 40 divided by 2,193. Which is 1.82%, and this was 1.74%. So of course, in 2018, it has a lower percent of trade receivables as uncollectible. So it has the higher quality trade receivables in 2018. Let us solve question 9. So in question 9, what we have is, we have two companies, Procter & Gamble and Colgate-Palmolive. We have net sales, accounts receivable for 2 years. Compute the accounts receivable turnover and DSO. So accounts receivable turnover is your sales divided by average accounts receivable. So our sales is 66,832 for Procter & Gamble, divided by average accounts receivable. So what that basically means then, 4,004 plus 4,000. I'll calculate the denominator first. So we have to round to 1 decimal. So it will be 16.4. If we follow the same process, we will get 12.3 for Colgate-Palmolive. Now, what is DSO? It is days sales outstanding. So that is our DSO. So what we do, we divide 365 days by our accounts receivable turnover, which is 16.4 for Procter & Gamble. And we will get 22.3. Following the same process, for Colgate and Palmolive, we'll get 29.7. Now, part B, which company collects its accounts receivable more quickly? So to answer this question, we need to know how to interpret these two ratios we just calculated. So accounts receivable is your sales over average accounts receivable. So ideally, you want as little accounts receivable as possible. You want to collect in cash as much as possible. So if average accounts receivable turnover ratio is low, so that means you have more average accounts receivable relative to sales than you'd prefer. So if this ratio is low, average accounts receivable turnover ratio is low, you have more accounts receivable, which you do not want. In this case, Procter & Gamble seems to have a higher average accounts receivable turnover. But at the same time, we also need to look into DSO, days sales outstanding. Now, in case of days sales outstanding, what we do, we take 365 days and divide it by the average accounts receivable turnover. So what we are basically saying, how long it takes to collect accounts receivable on average. So higher this number, poorer the company is in terms of collecting its accounts receivable. DSO is lower for Procter & Gamble and higher is Colgate and Palmolive, although Colgate and Palmolive has a lower accounts receivable turnover. So that means it has a relatively less average accounts receivable compared to sales. But in terms of number of days, which company collects its accounts receivable more quickly, it is a Procter & Gamble that collects its accounts receivable more quickly. So it should be Procter and Gamble. So that is it for today. I hope it is helpful for you all. I will see you in the next video. Take care, guys. Bye.